Your money-making broadcast starts now. Good evening, Canada. Today is June 8, Monday. Here are the top stories moving the markets. We are navigating a volatile transition as a massive tech sell-off in the US clashes with a sudden surge in global energy prices, creating a complex landscape for Canadian investors. From the war-fed shock to the reignited tensions in the Strait of Hormuz, we break down where the risk lies and where the opportunities are hiding. In this session, we will analyze why the TSX is diverging from the Nasdaq, the specific technical triggers causing the tech exodus, and how the Bank of Canada's upcoming decisions will interact with the current energy rally to shape your portfolio's returns over the next quarter. Before we dive into the big stories, let's look at the market close. The US markets had a brutal Friday. The S&P 500 closed at 737.55, down 2.58%. The Nasdaq fell for 0.18%, and the Dow also showed weakness. The Russell 2000 followed suit, confirming a broad market decline. In the volatility index, the VIX surged to 21.51, though it stabilized over the weekend to 19.86. In the commodities space, we see a massive divergence. Brent crude jumped to $97.20, up 4.42%, while gold and treasury yields are reacting to the Fed's hawkish turn. Bitcoin remains volatile as the risk-off sentiment takes hold. For the TSX, the energy surge is a critical buffer, but the overall regime is now officially marked as Bear Day 4. This regime shift is significant because it marks the end of a prolonged period of complacency, forcing investors to prioritize liquidity over growth. Big Story 1, the energy pivot and the Canadian advantage. While the US markets are reeling from a tech bloodbath, Canadian energy interests are finding a sudden wind in their sails. Brent crude has spiked to $97.20, a significant 4.42% increase, driven by reignited geopolitical risks in the Strait of Hormuz. For the TSX, this is a critical lifeline. Java's analysis indicates that we are seeing a classic flight to hard assets during periods of monetary uncertainty. When the U.S. Federal Reserve signals tightening through a shock like the war's inauguration, the market often pivots from growth-oriented tech to value-oriented commodities. We are seeing this play out in real time. The Canadian dollar typically tracks oil prices, and with Brent pushing toward the $100 mark, we expect CAD to maintain strength against a volatile USD. However, investors must be cautious. The Java's regime assessment currently labels the market as Bear Day 4. This means that while energy prices are rising, the broader equity environment is fragile. We are not in a blind buying phase, rather, we are in a risk-aware accumulation phase. For Canadian energy plays, the focus should be on high-dividend producers who can withstand a broader market downturn while benefiting from the crude price surge. The contrast is stark. While the Nasdaq is bleeding out, the energy sector is providing the necessary hedge for a diversified Canadian portfolio. We are watching the technical levels of the TSX closely, as the energy weight here acts as a shock absorber against the contagion from Wall Street's tech crash. Specifically, we are looking for support levels in the energy index that suggest a sustainable rally rather than a short-term spike. If Brent stabilizes above $95, the TSX could decouple entirely from the US tech slump, providing a safe haven for regional capital. Big Story 2, the war-fed shock and the tech exodus. Let us dive deeper into what happened on Friday. It was a day of carnage for growth stocks. The S&P 500 closed down 2.58% at 737.55, but the real damage was in the Nasdaq, which plummeted 4.18%, and the QQQ, which dropped 4.8%. The catalyst was the inauguration of Warsh at the Fed, which the market interpreted as a hard pivot toward aggressive monetary tightening. This sent shockwaves through the semiconductor industry. We saw Broadcom drop 7.92% and AMD crash 10.86%. Java's data shows a massive spike in the VIX, which jumped 34% to reach 21.51 on Friday. This is a clear signal of a fear regime. Even though we saw some weekend stabilization with the VIX dipping to 19.86, the damage is not yet undone. The Nikkei's 3.85% decline on Monday suggests that the global contagion is still spreading. For the Canadian investor, this serves as a warning against overexposure to US tech. The Druckenmiller principle of maintaining a high cash position, specifically around 65%, has proven to be the only effective defense line in this environment. The Java system has currently blocked almost all major tech tickers, including the giants, due to a negative edge guard. This means the probability of an immediate upward reversal is too low to justify new entries. We are seeing a regime transition from a 42-day bull run into a bear phase, and the technicals suggest that the bottom is not yet firmly established. The focus now is on capital preservation and waiting for the Wednesday CPI data, which will be the ultimate gatekeeper for the next move. If the CPI shows sticky inflation, the Fed's tightening will be even more aggressive, potentially pushing the Nasdaq into a deeper correction before any meaningful recovery can begin. We must analyze the 10-year Treasury yield closely, as any spike above 4.5% will further compress the valuation multiples of growth stocks. Big Story 3, Macro Outlook and the Bank of Canada's Tightrope. As we look at the broader macro picture, the Bank of Canada is facing an incredibly difficult balancing act. On one hand, the surge in Brent crude to $97.20 puts upward pressure on domestic inflation, as energy costs trickle down into transportation and heating. On the other hand, the global bear regime, triggered by the U.S. Fed's hawkish turn, threatens to slow down economic growth. This creates a scenario where the BOC might be forced to keep rates higher for longer even if the economy shows signs of weakening, simply to combat the imported inflation from energy prices. Jarvis analysis suggests that the Canadian market is currently more resilient than the U.S. tech-heavy indices, but it remains vulnerable to a global liquidity crunch. We are seeing a shift in sector rotation. Investors are moving away from high-multiple growth stocks and moving toward defensive growth and high-yield dividends. This is where the TSX typically shines. We are monitoring the Canadian dollar to U.S. dollar pair closely. If the U.S. continues to tighten aggressively while oil remains high, the loonie could see a temporary surge, but the underlying volatility of the VIX at nearly 20 points suggests that volatility is the only certainty. The key for the coming week is the CPI print. If inflation comes in hotter than expected, the war shock will be amplified, and we could see a further slide in equity valuations across the board, regardless of the energy rally. This would likely lead to a double whammy, where both growth and value stocks suffer due to rising discount rates. For Canadian investors, the Bank of Canada now faces a tightrope walk. High oil prices are generally positive for the TSX and the Canadian dollar, but they also feed domestic inflation, complicating the BOC's rate decision. If Brent crude breaches $100, we could see Canadian inflation expectations rise, keeping rates higher for longer. Toronto-Dominion Bank and Royal Bank of Canada, as major energy lenders, benefit from the oil price surge while maintaining defensive balance sheets. The divergence between the TSX energy rally and the U.S. tech crash creates a rare opportunity for yield-seeking Canadian capital to rotate into domestic oil and gas dividends, which are currently offering compelling yields against a backdrop of global uncertainty. We recommend analyzing the payout ratios of these energy firms to ensure that the dividends are sustainable even if oil prices eventually mean revert. On the U.S. side of the border, the Warsh Fed shock continues to reshape the investment landscape. Canadian investors with dollar cost averaging into U.S. tech should pause those positions until Wednesday's CPI provides clarity. Our portfolio currently holds a 65% cash position in Canadian dollar terms, which protects against both U.S. equity downside and currency volatility. Remember that the Canadian dollar historically tracks oil prices, with Brent near $100. CAD strength against the USD provides an additional buffer for Canadian investors holding U.S.-listed securities. This currency tailwind, combined with energy sector momentum, makes the current environment uniquely favorable for Canadian portfolios compared to their U.S. counterparts. We are essentially seeing a strategic shift where the safe play is no longer the S&P 500, but a balanced mix of Canadian energy and high-grade cash equivalents. To wrap up today's session, we are operating in a confirmed bear regime on day 4. While the energy sector is providing a vital hedge with oil climbing toward $100, the tech sector remains in a freefall following the Fed's hawkish shift. Our priority is capital preservation and strategic selection of value-driven assets. Now, let's look at the Jarvis recommended watch list for different investor profiles. First, for the safe-type investor, the legendary father of value investing, Benjamin Graham, would choose Fairfax Financial Holdings, FFH.TO, at $2,220.71. This pick is based on a strong focus on the safety margin and intrinsic value. Fairfax provides a diversified insurance moat that protects capital during the current bear transition, making it an ideal anchor for a conservative Canadian portfolio. He would emphasize that the current price offers a reasonable entry point relative to the company's book value. For the balance-type investor, the legendary Wall Street fund manager Peter Lynch would look at diversified miners. However, looking at our current risk-aware list, a balanced approach would favor a play like First Quantum Minerals, FCX, at $63.37. This provides exposure to copper and the global electrification trend, balancing the risk of a tech crash with the tangible demand for industrial metals. He would likely argue that the long-term demand for copper outweighs the short-term macro noise. For the growth-type investor, the world's leading innovative fund manager Kathy would typically seek high-beta tech, but given the current blocked status of most AI plays, she would pivot to a high-growth fintech like SoFi Technologies, SoFi, at $16.03. Despite the volatility, the long-term digital banking disruption remains a core thesis, though Jarvis advises a strict stop at $9.50 to manage the downside risk. This allows the investor to capture growth while strictly limiting the maximum potential loss. Finally, for the low-cost or contrarian investor, the global investment master John Templeton would identify a value play in the current dip. He would look at a recovery play like Broadcom, AVGO, at $385.73. While the stock took a hit on Friday, the fundamental dominance in networking and AI infrastructure suggests a long-term recovery. However, this is a high-risk entry, and the investor must be prepared for further volatility before a trend reversal occurs. He would view this as a classic opportunity to buy a quality asset at a distressed price, provided the long-term thesis remains intact. Subscribe for daily Canadian market insights. We break down the data so you don't have to. Check our shorts for a 60-second highlight. That's all for today. We all become wealthy together.